Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today we're doing something a little different because I've invited the person who sent this question to participate in today's video. So let me slide over as I invite Hank Goldman, a friend of mine, to read the question that he sent to me. Come on over, Hank.
Thanks, Alan. My question's pretty simple. What is your opinion about selling an in-the-money covered call for below the price of the underlying stock versus an out of the money? For an example, with GE trading at $8.18, I can sell the September 20th $8 call for 52 cents or the September 20th $9 call for 13 cents.
Okay, well, thanks, Hank. One of the reasons I asked Hank to come down to participate in this video is because that question is so very important to the BCI methodology. Option selection is the second of the three required skills, along with stock selection and position management. So let's first take a look at the question that Hank asked, and then we can break it down and hopefully get a nice definitive answer. So on August 20th, 2019, GE was trading at $8.18. On that same date, we had an opportunity to sell the September 20th or 1 month expiration $8 call or the $9 call. Now, which we would select is dependent on a few things. First of all, we have to establish which strategy are we using. Are we using traditional covered call writing, which is what I use in my accounts, or are we using portfolio overwriting, where we use an account, a long-term buy and hold account that we've held for many, many years, perhaps at a low cost basis, and we want to retain those shares. We don't want them taken away from us. So it depends on the strategy. Now, if we're using traditional covered call writing, which is what I use, we're going to take into account fundamental analysis, sales and earnings growth, along with technical analysis, which is evaluation of the price chart. So let's start at that point. Let's evaluate General Electric, GE, at that point in time on August 20th, first from a fundamental perspective. Now, if we take a look at the IBD Smart Select screening, which is what we use in the BCI methodology as one of our fundamental screens, you could see here on the screenshot that there are 6 categories. One of the things I like about this screen that it takes into account fundamental and technical analysis, not only of the stock, but also the industry that that stock resides in. Now you could see in the middle column that there are letters and numbers. We don't really look at those. What we look at is the column all the way to the right called the checklist. You'll notice 6 circles, and the circles are colored in. In the case of GE, 5 of those circles are colored in red, which is the lowest ranking possible. One of the circles, the one that says Group Relative Strength Rating, is colored in yellow, which is a middle of the road rating. There are no green circles at all. So overall, this fundamental related situation is bearish for GE. So right away, I'm not liking this stock very much. Now let's next turn to a price chart or technical analysis of General Electric. Again, on August 20th, when Hank first sent me this question. If we look at the top part of the chart, the moving averages, you'll see that we have a moving average trending down by the red arrow, and you could see that there's actually a bearish moving average crossover at that point in time. Now if we move down to the middle of the chart, the MACD histogram, you could see that the red arrow in the middle is pointing also to a descending momentum indicator, also a bearish indicator. You may note that the blue bars in that middle part of the chart are also below zero. Again, a bearish signal. Finally, if we move down to the red arrow on the bottom, you could see that the stochastic oscillator, also a momentum indicator, is pointing downward, a bearish indicator. Also, it's dropped below the 80th percentile, so that makes that bearish signal even worse. All of these bearish signals, if you take a look at the green circle at the bottom, are on relatively high volume, making them even more significant. So to summarize, fundamentally and technically, this is a pathetic evaluation of General Electric and a stock that I would not want in my portfolio. If we're doing portfolio overriding where we are committed to this stock for the long term, that could be another situation. Let's take an even broader look of this stock over a 5-year time frame. Well, in the screenshot that you're looking at right now, you could see that prior to 2017, General Electric was doing fairly well. It was trending up, and it had reached a fairly decent price point. But in 2017, it started to descend, and precipitously. So if we took a look at this 5-year chart and say, well, are we looking at a bullish or a bearish stock? I would definitely put it in the bearish category, hammering home what we looked at in the shorter term analysis from both a fundamental and technical perspective. So I think at this point you're starting to see I'm really not liking this stock at all. But let's assume for a moment that we are going to evaluate the amount that we can generate by selling options on General Electric on August 20th, 2019. We're going to go 1 month out to the September 20th expiration contracts. Now, Hank told me that the $8 call generated 52 cents and the $9 call generated 13 cents. So we're going to feed this information into the multiple tab of the Ellman Calculator, and you'll see we enter the information on the blue cells on the left side of the spreadsheet, and then the white cells become populated. So let's look first at the in-the-money strike, and that's the $8 strike lower than current market value. And in this spreadsheet, you could see that the return on the option, or the ROO, generated a 4.3% 1-month return. If we were to annualize that out, that would represent a 52% annualized return. So we get a phenomenal return on the option for General Electric. So that's the good news. Now, we would tend to use the in-the-money strike if we're bearish on the market, bearish on the stock, because we get an additional downside protection of 2.2%, as you could see on the top right part of the screenshot. So what that means is we're guaranteed a 4.3% 1-month return as long as the share value does not decline by more than 2.2% by contract expiration, or 1 month out. So that looks like a pretty good deal. Now let's say we were more bullish on the overall market and we wanted to use an out-of-the-money strike, one higher than current market value, which is one of the ones that Hank was considering. Well, we had a return of 13 cents. What does that mean? That means that the return on our option, the actual time value profit we're going to generate in 1 month, is 1.6%. If we were going to annualize that out, it would annualize out to a 19% 1-year return. Still pretty good. But have a look at this now. If General Electric moved from current market value of $8.18 up to the $9 strike at the end of that 1-month contract, we will have generated an additional 10%. So we have an opportunity in this particular case to generate an 11.6% 1-month return. Again, if we were bullish, we would tend to go with the out-of-the-money strike. So in some situations, the in-the-money is more appropriate. In some situations, the out-of-the-money is more appropriate. So there's good news in that A, we have an opportunity to purchase a stock at a very low price, $8.18, and B, the option return for both the in-the-money 8 strike and out-of-the-money 9 strike is phenomenal. So that's the good news. The bad news is it's a terrible stock from both a fundamental and technical perspective. So let's do a comparison now of both the in-the-money and the out-of-the-money strikes, just to kind of summarize everything. The in-the-money strike is used in traditional covered call writing. If we're doing portfolio overriding on stocks that we absolutely are committed to for the long term, we don't want them sold, we would only use out-of-the-money. So the in-the-money is more appropriate, generally speaking, for traditional covered call writing, the way I do it. And we would use it for traditional covered call writing when our overall market assessment is bearish, or our stock assessment may be somewhat compromised because of a mixed technical chart. I'm not talking about the kind of chart we looked at with GE. That's all negative, and I wouldn't use it. But if it's mixed with some of the indicators positive and some negative, I would tend to use an in-the-money strike. But that strike, as with all strikes, must meet our initial time value return goals. In my case, I strive for 2 to 4% a month for my initial profit, and also downside protection for in-the-money strikes. So if I'm shooting for 2 to 4% time value profit, it must meet that goal, and then the additional downside protection, which we looked at before. And so depending on how much protection we're looking for, will dictate whether or not that in-the-money strike is appropriate for our portfolio. All right, so let's look now at the out-of-the-money strike, which is appropriate for both traditional and portfolio overwriting. For portfolio overwriting, I only use out-of-the-money strikes. And so depending on what our target goal is, we would select a strike that meets that goal. Now for traditional covered call writing, I use out of the money when we have a bullish overall market assessment, and the stock charts are bullish generally speaking, and I would tend to go out of the money. Again, the out of the money strike, just as the in the money strike, must meet our initial time value profit return goal range, as well as upside potential. Remember, the upside potential in the case of GE for the 9 strike was 10%. That's just a 1-month return. So the strike selection is so very important, and that's why Hank's question was so important, and I'm glad he had an opportunity to come down and participate in this video. So let me get Hank back in here again and see how I did here. So Hank, why don't you show your handsome face to the BCI community?
Thank you, thank you.
And how did I do?
Well,
did I answer your question?
Thanks,
okay?
Alan. It was a really concise answer. I just had a quick follow-up.
Yeah.
Can you go over the moving average crossover you mentioned earlier?
Sure. So yeah. So all right. So let's go back to the technical chart where I talked about the fact that the technicals were pretty poor, generally speaking. But all right, so let's have a look now at the top part of the chart, and you could see, Hank, in that yellow field on the top, that the 2 moving averages that we use in the BCI methodology, the top line is the blue line there, and that represents the 20-day exponential moving average, and the red line below it in that yellow field represents the 100-day exponential moving average. And of course, we always like to see the more recent prices higher than the older prices. In this case, the blue bar, even though it's running sideways and kind of, they call that consolidating, the blue line is above the red line. So that's kind of positive. But once it starts declining, and that you see that red arrow on the top, you see the price decline, very significant on the right side of the chart here, you'll notice that the blue line now turns underneath or below the red line. And that's a very bearish signal. That's called the moving average crossover. So the shorter term moving average is performing worse than the longer term moving average. They're both performing terribly, but the more recent price is even worse. So this would be just another reason not to use GE in our portfolios. Once again, unless for whatever reason you've decided you wanted it part of your long-term buy and hold portfolio, in which case you would do portfolio overwriting and only use out-of-the-money calls. But I'm glad, Hank, that you brought that to my attention. So why don't you come back in the screenshot here,
Sure.
Hank? Show that handsome face again. I'll move
Thank
over
you.
for you a little bit.
Thank you.
So let me conclude the way I always do. And as always, this is Alan Ellman, along with my friend Hank Goldman. Take care, everybody.
Bye-bye.